Hello everyone, welcome to today's session. In this video, we'll break down repurchase agreements under IFRS 15. Repurchase agreements are transactions where an entity sells an asset but also retains the right or obligation to buy it back in the future. These agreements impact financial reporting because they affect whether a sale is recognized or if the transaction is treated as a lease or a financing arrangement. There are three types of repurchase agreements. One, a forward where the entity must repurchase the asset. Two, a call option where the entity has the right to repurchase the asset. And three, a put option where the customer can require the entity to repurchase the asset. Let's break down how these agreements are accounted for under IFRS. If an entity must or can repurchase the asset under a forward contract or call option, the customer does not gain control of the asset. This means the transaction is not treated as a sale under IFRS 15. Instead, it is accounted for as either a lease under IFRS 16 if the repurchase price is less than the original selling price, or a financing arrangement under IFRS 9 if the repurchase price is equal to or greater than the original selling price. If the repurchase price is lower than the original selling price, this suggests that the customer is not truly purchasing the asset. They are only paying for the right to use it for a period of time. In this case, the entity retains the control of the asset and acts as a lessor. The contract is treated as a lease under IFRS 16 unless it is a part of a sale and leaseback transaction, in which case the entity recognizes a financial liability under IFRS 9. Imagine company A sells specialized equipment to customer B for rupees 1 lakh but has an agreement to repurchase it for rupees 90,000 after 3 years. Since the repurchase price is lower than the original selling price, customer B is effectively leasing the asset rather than owning it. This is treated as a lease under IFRS 16. If the repurchase price is equal to or greater than the original selling price, the transaction is structured more like a loan than a sale. In this case, the entity continues recognizing the asset and records a financial liability for the amount received by it. The difference between the receipt and the repayment amount is recognized as interest or holding costs. Now, imagine company A sells the same equipment for rupees 1 lakh but agrees to repurchase it for rupees 1 lakh 5,000. Since company A is paying more to buy it back, this is actually a financing arrangement and not a true sale. The entity records a financial liability under IFRS 9 and recognizes rupees 5,000 difference as an interest expense. When an entity has an obligation to repurchase an asset at the customer's request, that is a put option, the accounting treatment depends on whether the customer has a significant economic incentive to exercise such right. If the repurchase price is lower than the original selling price, we need to assess whether the customer has a significant economic incentive to exercise the put option. Now, how do we determine this? We compare the repurchase price with the expected market value of the asset at the repurchase date. If the repurchase price is higher than the expected market value, it is likely that the customer will exercise the put option since they can return the asset for more than what it would be worth in the open market. This means the customer is effectively leasing the asset, paying for the right to use it for a period of time. In this case, the transaction is accounted for as a lease under IFRS 16. The entity continues to recognize the asset and records a lease liability unless it is a part of a sale and leaseback transaction. If it is the case, then the entity recognizes a financial liability for under IFRS 9 for the amount it has received. If the customer does not have a significant economic incentive to exercise the put option, then the transaction is treated as a sale with the right of return under IFRS 15. This means the customer has a genuine control over the asset but retains the right to retain it. The entity recognizes the revenue at the time of sale but also records a refund liability for potential returns. If the option lapses unexercised, the liability is derecognized and revenue is fully recognized. If the repurchase price is equal to or greater than the original selling price and is also higher than the expected market value, the transaction is in effect is a financing arrangement under IFRS 9. This means the entity continues to recognize the asset on its balance sheet. The amount received from the customer is recorded as a financial liability. The difference between the receipt and the repayment amount is treated as interest or holding costs. This reflects the economic substance of the transaction. It is not a sale, but rather a form of secured borrowing. Let's go through an example to see how this works in practice. Imagine company A sells machinery to customer B for rupees 1 lakh with a put option, allowing customer B to sell it back in 3 years for 85,000. If the expected market value of the machinery after 3 years is 75,000, the customer has a significant economic incentive to exercise the put option, since selling it back for 85,000 is a better deal than selling it in the market. In this case, the entity accounts for the contract as a lease under IFRS 16. Now, what if the expected market value in 3 years is 90,000? The customer is unlikely to return the asset since they could sell it for a higher price elsewhere. Here, the contract is treated as a sale with a right of return under IFRS 15. Finally, if the repurchase price is 1,10,000, which is more than the expected market value, the contract is effectively a loan and not a true sale. The entity does not de-recognize the asset and records a financial liability under IFRS 9. Repurchase agreements significantly impact financial reporting under IFRS, determining whether a transaction is classified as a sale, lease, or financing arrangement based on entity's right or obligation to repurchase the asset. If the entity has an obligation or a right to repurchase the asset, the customer does not obtain control. Instead, it is treated as a lease under IFRS 16 if the repurchase price is lower than the selling price. It is classified as a financing arrangement under IFRS 9 if the repurchase price is equal to or greater than the selling price. If the customer has the right to require a repurchase, the accounting depends on their economic incentive to exercise it. If the repurchase price is higher than the market value, the customer is likely to return the asset. It is treated as a lease as per IFRS 16. If the customer is unlikely to return the asset, it is treated as a sale with the right of return under IFRS 15. If the repurchase price is significantly higher than the market value, making it a secured loan rather than a true sale, it is treated as a financing arrangement under IFRS 9. By correctly identifying the type of repurchase agreement, forward, call option, or put option, entities can ensure compliance with IFRS and accurate financial reporting. Thanks for watching, and I'll catch you up in the next video.